You buy a solid stock. It reports great earnings, but instantly your expectation of a profit shatters as the stock drops 10% in seconds. Look at this split-screen graphic. On the left side, a company beats Wall Street's estimates, yet its stock price plummets. On the right, a different company completely misses its targets, and the stock goes on a massive rally. If you've ever tried to figure out why this happens by reading an actual earnings report, you probably hit a wall of terms like operating margins, top-line growth, and EPS. Today, we are taking those massive, intimidating financial releases and isolating the exact data points that trigger these sudden stock swings. To do that, we will use a 5-step checklist. This is the same process professionals use to evaluate Apple, Nvidia, or any other public company. Before we start, pull up a recent earnings press release and analyst estimates for a company you own. We will walk through it together. This framework provides a repeatable way to analyze a business using the same data points that drive institutional trading. At its core, a quarterly earnings report is simply a financial report card. Public companies release them 4 times a year. When you open one, you will see a wall of numbers like this statement. We need to filter this data down to 3 specific rows: revenue, EPS, and forward guidance. Step 1 on our checklist is locating revenue, often called the top line. This calculates the total money brought in from sales before any expenses are paid out, like selling 1 million phones at $1,000 each to generate $1 billion. To see if customer demand is actually accelerating, we calculate the year-over-year growth. You take the new revenue, subtract last year's revenue, and divide by last year's number. Step 2 is locating EPS, or earnings per share. This measures profitability by taking the company's total profit and dividing it by the number of shares outstanding. But EPS comes with a trap. While revenue is hard to fake, management can adjust their EPS number to make the business look better than it actually is. Executives can slash research budgets, lay off staff, or use cash for stock buybacks. These tactics increase the profit per share without requiring the company to acquire a single new customer. Revenue proves that external market demand exists, while EPS proves the company operates efficiently inside. Checking both prevents an incomplete view of the company's momentum. Even if both of those historical numbers are perfect, the stock market does not react to the past. It buys and sells based on expectations for tomorrow's cash flow. That brings us to step 3, locating the forward guidance section within the press release. Guidance is management's official prediction for how much revenue and profit they expect to generate in the upcoming quarter. This explains why a company can deliver a quarter of record revenue and EPS, yet still see its stock drop. If management warns that future sales are slowing down, investors often sell the stock immediately. Because investors are paying for future performance, guidance sets the baseline for the stock's current valuation. Once you have the guidance, step 4 is evaluating how the stock price reacts in the seconds after the report goes live. Look at this balance scale to see how that mechanism works. The market weighs Wall Street's previous expectations against the actual results. In our first scenario, a company reports incredible growth, but the stock falls. This happens because Wall Street had already priced in perfection. Even great results tip the scale into the red when they fall short of unreachable expectations. The opposite happens when a struggling company reports poor numbers, but the stock rallies. The market had braced for a disaster. Because the reality was better than feared, the results outweigh the low expectations. To figure out where those expectations are heading next, step 5 is locating the live earnings call, which happens shortly after the data is released. During the Q&A segment, executives answer questions from analysts. You are listening closely for management's tone. Are they defensive about their margins, or do they sound confident in their future pricing power? The post-earnings price action reflects a direct adjustment as corporate data meets Wall Street's previous projections. By filtering out the noise, you now have the tools to look at earnings exactly how professional analysts do. Let's review the completed checklist on your screen. Step 1, check revenue for top-line growth. Step 2, check EPS for actual profitability. Step 3, read the guidance for future expectations. Step 4, weigh the stock reaction against Wall Street's reality. And step 5, listen to the tone of the live call. Utilizing these 5 steps allows you to move past the headlines and evaluate the underlying business. Look at your own portfolio right now and drop a comment below with the stock ticker whose recent earnings report was the most confusing to you. Like this video and subscribe to the channel, and we will keep building the systems you need to master the market. Thanks for watching.